We're beginning a new topic, merchandising, and how merchandising companies make purchases and sales. So our goals for this first section are understanding the difference between merchandising and service companies, learning the accounts cost of goods sold and inventory, new accounts, and understanding the costs of inventory. So what are examples of merchandise companies? Merchandise companies buy and resell goods such as Nordstrom, fashion, such as Avanza, groceries, and Mitra Adiperkasa is a number one retailer in Indonesia. What do all of these firms have in common? They all buy products and resell them. Unlike a manufacturing company which buys raw material, builds it into something new, and resells it. So how do we book the sale of goods with a merchandise company? We have a new account. We no longer use service revenue. We are going to use sales. And we need to add two new accounts in addition to sales, and they are inventory and cost of goods sold, also called COGS. And we're going to work within this video. So let's look at the difference between a merchandise company and a service company. In a merchandise company, we have sales, cost of goods sold, and see that sigma sign here. That means this is a calculation for gross margin. Then below gross margin, they are identical to service companies. And you've prepared this income statement several times so far. Go over to a service company, and they have service revenue, but they have no direct cost of goods sold because they don't sell goods. So gross margin, net income before tax, and net income are all calculations. All the rest of these are actual accounts. In the case of operating expenses, you would list each expense separately. So cost of goods sold is the total cost of goods sold during the current period. If it isn't sold, it's inventory. Service companies do not have goods, so they do not have cost of goods sold. What are the cost components for inventory? Inventory is reported on the balance sheet at its historic cost, and it's a current asset because it's expected to be used up within a year or operating cycle. And cost means all the cost necessary to get the asset ready for its intended use. So what are the cost components for inventory? The original invoice price of the inventory, referred to as cost, not price. Freight in, cost to transport the inventory from the vendor, the seller, to the company, the buyer. And cost will be reduced by any purchase discounts that the seller gives to the buyer. And if the buyer returns goods, of course, that will be reduced. Let's take an example. This ends part 1. Part 2 will be perpetual inventory journal entries, the purchase transactions.